And hello, everyone. Welcome to Options Unhinged, how to spot promising options setup. I'm very excited to have this to hold this webinar tonight because I think it's going to be one of a kind. Not only do we have, of course, a special guest invited today, but we'll also go through some tips and tricks and a bit of secret sauce on how to spot option setups and promising option trades. Now, before we get started, let me introduce myself. My name is Daniel Sinek, and I will be mainly your moderator today. Most of the talking will be done by our special guest, which I will introduce in just a second. I am greeting you today from our headquarters of trading indicators in Montreal, which is in Canada, in Eastern Canada. It is 6 p.m. Eastern Standard Time. And before we get into it, let me ask you the question, where are you guys calling in from? Please put your location into the Q&A section of your Zoom window. So who do we have today? Where are you calling in from? Let me see, who do we have? Okay. John, hey John, how are you? My good old friend John from Pennsylvania. Hey John, nice to see you. Who else do we have? And I see that we have a full house, so don't be shy, guys. Please put your location into the Q&A box. Who else do we have? People are still a bit shy. I see Bill. I forget where Bill's calling in from. Carl, we have G, Yan, Jen, John, another John, Keith. Yeah, John from St. John's, Newfoundland, Canada. That's awesome. Hey, John, a fellow Canadian. Nice to have you in this webinar. Okay, so I do see we do have an international crowd, just as always here when we have an event at Trading Indicators. All right, so we have chosen this title, Options Unhinged, purposefully, a bit mysteriously, because, we wanted to spark your interest. And, what we also have in mind today is a bit of an improvised session where you guys can make this webinar as much or as little to your own as you want. So please, throughout the session, ask as many questions as you have. Put them into the Q&A box. Request symbols. Ask our special guest anything you want to know. Yeah, this is an opportunity for all of you to make this session your own and get as much out of it as possible. All right, so how to spot promising setups, or in other words, the secrets of successful options trading. Now, before we get into it, let me remind you that this session will be recorded and the recording will be sent to you afterwards. So don't worry if you have to drop off for a couple of minutes, you will get the recordings afterwards. Also, when you trade options or really any security, stocks, ETFs, FX, cryptos, keep in mind that trading does contain substantial risk and therefore is not suited for every investor. If you trade, make sure to only use risk capital, which is capital that you actually can afford to lose. When it comes to hypothetical performance or backtest performance or really anything based on historical data, keep in mind that this is not necessarily indicative of future performance. And most importantly, any trade ideas shown in this webinar should not be construed as trade advice. These are for informational purposes only. All right, so with this out of the way, let me introduce ourselves a little bit better. So we are tradingindicators.com. And as mentioned before, my name is Daniel. I'm the guy here on the left-hand side. And we at Trading Indicators, we specialize in building innovative trading solutions. We've been out there for about 10 years, and over the years, we have built way over 700 different trading indicators, fully automated strategies, trading scanners, trading dashboards, trading tools. Most of them are rooted in what's called technical analysis, which basically does a mathematical analysis of your price chart. We believe that most of the fundamental data is almost immediately priced into the chart. And by analyzing your price chart, you will indirectly also take into account fundamental information. We also believe that trading should be simple, and trading is simple, but you need to know what to look for. You need to know and understand how to differentiate the noise from the significant levels. And one purpose of today's webinar is to share with you what we and what our special guest is looking for when it comes to trading and when it comes to trading options. Having all this said, welcome guys to this webinar and let's get started. And it is now time to introduce our special guest. We have, and if you followed us in recent history, you probably may have already guessed this, but we have once again the option professor here with us. So the option professor and we met, I forget when it was. Was it maybe 6 months ago? We met in Las Vegas at a trading conference. And we discussed, hey, let's do something together. And I was immediately amazed of his wealth of knowledge when it comes to options, but really anything about trading. So we decided, hey, let's do something together and let's do some webinars together. And this is one of the reasons why the option professor is here with us today. And Jim, do you want to introduce yourself real quick and
Sure.
say a few words?
Yes, that'd be great, Daniel. And good to be with you guys again. I'm Jim, the option professor. A little background. I went to Boston College over there in Chestnut Hill, Massachusetts, and I graduated from there and I attended the executive management program over at UCLA. Once I got into the investment area, I was sent over to the advanced option training program at the Chicago Board of Trade called the Options Institute. And so I had highly specialized training. I made myself familiar with the top option guys that I could find in the company, and I learned as much as I could by watching them trade and watching them do their stuff. I was a high-level person at some of these firms, and I've been doing this for a long time. I've conducted a lot of seminars, educating people. So this is no new, this is not my first rodeo trying to explain options to people, and I think I'm pretty good at it because it is a complex subject matter, but my job is to make it understandable to you, and I think I can do that as well. So I'm happy to be here. I'm excited. The stuff that we're going to talk about today is very exciting, and the markets obviously are exciting. So this is a great time to take a look at this stuff. So I'm happy to be here, Daniel.
Oh boy, awesome. Thanks, Jim. Thanks, option professor. So let me jump right into it and let's get right down to the nitty gritty. Let me ask you a loaded question. What is your secret sauce when it comes to options trading? What do you consider as crucial and important? Please take it away.
Well, the thing that is very important to me to start out with is looking at where the market is on whatever I'm looking at. Okay. So I do an analysis on the market, and the two main things I do on it is I look at the trend and I look at the momentum. And I look at those two things very closely. So I start with a technical analysis on the stock. And of course, I watch Bloomberg and I watch my CNBC and I watch my Barron's Roundtable, and I listen to people all the time and absorb information. So I have some idea of the general tenor of what's going on out there. In other words, is energy hot or not? Is the metals going nuts? Is it all in tech? Are they rotating into small caps? I'm keeping aware of what's going on, but then I always go back to my technical analysis and I look at that very closely. So first I have to understand where I think the train's going, right? Then I have to find out what the ticket costs. Now that's called implied volatility. So if something has already moved, like Taiwan Semiconductor has already gone from 190 down to 160, it might be a little late to do some strategies at that point. That would eliminate some strategies as being a reasonable price, right? It might enter strategies that are more appropriate after a huge move. So then the point I'm trying to say is the secret sauce is to deciding which strategy is right for the environment I'm looking at. And then, of course, I have to work with the time, because with options, you're dealing in time and price. So the bottom line is I have to figure out how much time I'm going to need. And then I have to figure out what strike price I think is appropriate. And then I have to figure out, is the premium favorable to me based on what I'm trying to do, or is it unfavorable? If it's unfavorable, it's a no deal. And so that's the secret sauce is a combination of finding out where you think these markets are going. Then you look at what strategy you think is appropriate for what it looks like. Then you price it out, strike price, expiration, and premium. And then you figure out what strategy based on that is the best, because there's more than one way to skin a cat, and therefore, basically, I have a variety of strategies. So the secret sauce is really in the analysis. I wish it was just one answer. If it opens up 5 points higher, buy the calls, you'll win every time. That's just not the way it works.
Perfect. And we're going to look at some charts in just a second. But Jen, let me ask you a question, just another one, and then we're going to jump into the price charts. Do you
Sure.
have a favorite option strategy that you use in your trading, or was there one in the past and maybe it has shifted to something else
Well,
these days? Or
yeah. Well, again, I used to enjoy option writing because obviously the probabilities statistically are pretty good. The problem is you're only bringing in a fixed amount of money, and if you're wrong and you don't have an exit strategy that's, shall we say, eloquent, you can lose a lot of money on it versus how much you made. And so you have to be very careful on your risk management when you do the writing strategies. But clearly, the sell side has a lot of benefits to it, but not if you're trying to make a lot of money with a small amount of money. And that's basically one of the strategies I like right now. And believe me, this market's been tailor-made for it, and I'll show you examples. But it's the strangle strategy. And basically, it's a volatility bet. And obviously, if you're going to bet on volatility, it's going to be better to do it before volatility shows up. So what I do for the subscribers and what I do for myself is I scan everything on news that's coming up. And I can show you some examples a little bit, but like last month, what did we know about Apple? They were having a big convention. What was the convention? The Worldwide Developer Conference. What were they going to talk about? AI. What were they going to try to figure out? Well, can AI go into the iPhone and the iPad, and can we get all these people to reload and get new equipment? If we can, we're going to make a lot of money. So before the event, there was not much volatility on Apple. It was trading between 185, 195, right near the all-time highs. So I said to myself, well, they got a big conference here. The stock's on an all-time high. If the conference goes badly, it's probably going to tank. If the conference goes well, 300 million people who might upgrade their stuff is a pretty good deal. So that would be tailor-made for a strangle, which is something that I did personally. And I bought a 200 call with a couple of weeks on it, meaning the week of the event and the week after, and then a put at 190. So that's called a strangle because the stock was at 195, 190. 200 is out of the money. Above, that's a call. Underneath the market is a little out of the money, put. They both cost a fixed amount of money. In this case, I think it was about $300, a little bit over. And then after the convention, Apple goes to 220 in 2 days. And all of a sudden, a $186 call at 200 jumped up to $2,000. And so that doesn't happen all the time, but it can happen, especially when there's news of significance after you put on the position. And that's why I've been trying to take advantage of the earnings season, because earnings, as you can tell, can be very dramatic on the prices. Not to mention, we went to what I would consider to be an excessive price on the S&P and the NASDAQ, and a reversion to the mean, which subscribers saw right in my update on the last few updates. I said, I'm expecting a reversion because this thing looks tired and it's way away from its moving averages. It's tailor-made. And exactly what we have seen in the last week or so is the reversion that I talked about. So again, the strangle position properly done before volatility is one of my favorites, because who doesn't like to risk a little bit of money and then try to make a lot of money? Or if you're wrong, lose a little bit of money. I like that.
Yep. I guess that sounds pretty sweet. And I agree with you. So lots of these strategies that I personally also have focused on is exactly in that vein to, try to risk a little bit, but potentially make a lot. It will not happen every time, but if you're right, you can.
That's why you play. That's why you play. And
right.
Just give you the difference. I showed you an example of a strangle on Apple. A 200 call above the price and a 190.
Jim, do you want to put on your charts? Maybe share your screen so
that
we make it a bit more concrete.
That would make it a little bit less blind, right?
Yes, exactly.
Okay. I'll put the Apple thing up so we can start with that.
Go for
it. And then I'll go over to a straddle, because I've done all these strategies before, so I'm not new to this. Okay, so we got Apple. Oh, I got to share. Where's the share?
Yes, please go ahead and share.
Sharing is caring, right? Here we go. Okay, so now I'm sharing.
Yeah, we can see a chart.
Okay, so here we go. Apple example. Here it is in the beginning of June, trading between 185, 195, right? They're having the conference. I already know it's in an uptrend as far as my stuff is concerned. So obviously, I'm probably thinking it's going to break to the upside, but you never know with this stuff. And why not buy both sides if it's not that much money? So The call was at 200. You can see the strike right there, the price right there. And the put would have been 190 underneath. And then you're waiting for the event to make something happen. And there you go. Boom. That's called something happens. Now, somebody would say, what did you do after it went up there? Well, to be honest, the first leg up, I like that money. So I grabbed it. And then I changed my strike from 200 because I sold the 200 at well more than I paid. And then I took another position at 207, which is just a little bit higher than the 205. And then that ran up to 220. And then I got out. And then because I can see it's far away from my averages, I'm a reversion to the mean guy, meaning I don't believe the trees do grow to the sky. And so basically I had extra money, right? I mean, come on, I had extra money. So I threw my hat in the ring on a put, looking for it to pull back to the price. And it did. Now it's pulled back to the price, but I can see that I'm not going to, I made a hit here. I'm going to take it. And then what do I want to do next? Well, I took a shot at a very cheap option up at 225 when it was around 215. And obviously it was a very cheap option, but I have a little extra money, right? So I can afford to take a chance with extra money. Well, I didn't think it was going to go to 235 or right about 100 of them, right? So I got some 225s. They went up, and then I said goodbye, and I haven't done anything with Apple since. Now that it's back to the blue line, I'll sniff around a little bit, and it may stop here. So I'd be very much looking at the long side if this thing can hold, because this would be the neighborhood where it would stop. Particularly if I go to my 5-year graph and I get some confirmation that my red line is holding up. So let's see now. See, red line's down here. So there's still downside potential if that 217 breaks. And that would be down to 206, 207. So we're in a reversion to the mean time. And what that means for the unsophisticated or the newcomer is when you get way away from the averages, it reverts to the averages. When it gets way away from the averages, it reverts to the averages. So my advice, and I'm not giving advice, let's say my idea, because I don't give advice, I give ideas. My idea is don't buy buying things when they're way away from the averages, because you are in a position where you're going to get whacked if you do. So if you want to buy things, try to buy on an uptrending thing, try to buy them when they come back to the lines, come back to some type of a 50-day or 200-day or whatever you use. There's 9 million moving averages out there. I'm not saying I've got the only ones, just these are the ones I believe in. So that's the story on the strangle. And now, how would we have lost?
Sorry, Jim, real quick, since you talked about the moving averages that you use, which ones are these? I can see the red one.
Yeah,
is the
I mean,
SMA
but like I say, they're just my personal ones, but they're the ones I've concluded are the ones I want to follow. But there are many. I got the 12, the 24, the 36, the 120, and the 250.
Got it.
My feeling is the red will tell me when the direction of the trend changes. Green and blue will confirm that something major might be going on. Purple and gold are very overdone conditions. And it could be a trend change. For instance, Apple looks like garbage here, right? But I told you, if it changes above gold and purple, it could be a trend change. Obviously, this is a lousy trend, but once it got above 180, it was home free. Load the wagon and ride it up. Okay, so I use these averages to give me an idea of when things are very favorable, because that's what we're kind of trying to do here is when we're trying to do things when they're favorable, not just because we got out of bed on that side of the bed that day. You know what I mean? So that's that. And then basically, I want to show you a straddle. I did this on the Ford Motor Company because the premiums were very low because the market is, was like $14. And you went up to like 1450. You could do a 14 or a 1450 straddle, for a week or two, not a long-term thing, but it would have been like in the $1.50 range, right? And then look at this. It falls out of bed and Santa came early. Doesn't happen all the time, but during earnings season, obviously it can happen sometimes, and that's why you take your shots. So that's an example of a straddle where you buy the call at 14, you buy the put at 14, or you buy the call at 1450 and the put at 1450. You pay premium on both sides, right? You're buying it. Limited risk. You lose the premium, nothing more. And then if it falls out of bed like this thing is, obviously, what do you think the 14 puts would be worth? Down at 11, it's got to be worth $3. So not too shabby.
Jim, real quick, just for clarification for our audience, So you just now mentioned you took a straddle on this one instead of a strangle. So a straddle,
Because
just
it
for
was cheap.
clarification. Yeah,
Yeah.
exactly.
Yeah.
Just
A straddle is when the call and the put are the same exact strike price. I don't do that very much because when you do that, you're paying a lot of premium unless the premiums are cheap. And of course, I have a judgment call on that, whether they're cheap or expensive, and my judgment can be correct or incorrect. In this case, it was quite correct. Now, the thing is unless your name is Murphy, the only way you lose on both sides is on expiration day. The stock lands exactly on your strike price. Can it happen? Sure. Does it happen all the time? I don't think so. But again, that's how you would lose on both sides. Otherwise, it would either be above the strike or below the strike, and you get some of the money back on one or the other side. But again, generally speaking, I don't like to do this because, again, I'm looking for volatility. So I tend to go a little bit out of the money up on the call and a little bit out of the money underneath on the put because I'm looking for volatility. What is
awesome.
the worst? The worst thing that I hear is things have all calmed down, and that's not the game I'm playing. Now, the other thing I'm going to show you is I wouldn't do anything with this stock here. Why wouldn't I do anything? Because the options were cheap up here. Down here, because of that volatility, premiums are going to be substantially higher. And I don't really feel like I have an edge. See, when it was up here, let me put the RSI up here. Let's see if there was any divergence. Well, I mean, this thing was also, I mean, Tesla, I think, had already tanked before this thing tanked. And this thing had earnings. And when the earnings came out, it's kind of like your report card. And anybody probably had that trepidation when you go bring your report card home to your parents and, they think you're getting A's and all of a sudden, boo. Well, same thing here. These guys were thinking everything is cool. I mean, obviously, it doesn't go from 12 to 15 because everybody thinks things are terrible. Well, they were terrible. And that's why you go back to 11 because everybody who bought in all wanted to sell out at the same time. So if there's nobody on the buy side and everybody wants out, there's a guy called the market maker, and he's going to drop the bid to 11 and he's going to say, come on out, I'm here.
And Jim,
mm-hmm.
Let me just chime in just real quick, and I don't. Sorry for interrupting you, because you brought up a very important point, and the point of timing. So an idea is only as good as the timing is also right for that idea. So the idea that you had on this straddle was great yesterday because earnings were coming up and the straddle price was very cheap. Today, completely different story. The move has happened. The earnings are done. There's no more earnings coming up tomorrow. And this idea is no longer valid today. And later on, we're going to expand a little bit on how an idea can also expire. And you have to be very aware of this.
Oh, well, that is our risk. I mean, if we get into things that we think are volatile and they're not, and they expire, that is how you lose the premium. That is the long and the short of the risk side. Now, again, after you get something like this, your job, in my view, is to go find another one that looked like that.
Yep.
And that's why God created 5,000 stocks.
Exactly. Jim, can you bring up IBM? Because I think the next topic I'd like to discuss with you is even for the same symbol, you could use a variety of different option plays to trade a move that you have in mind. So IBM.
Yeah. And I've had a great time with IBM because I could really smell a turn, and down here in the 165, 170 area, I had a lot of things telling me it's going to turn. So this one was kind of a no-brainer. And so I'm going to tell you a couple of different strategies you could have done to take advantage of this. First of all, these guys have a product that people could use instead of CrowdStrike. So if you want to know why everybody wants in on this thing, do you think their salesman is not going in there saying, hey, you got to get rid of CrowdStrike and give us a hand here. You want another breach like that guy got? I mean, I think that's the pitch. Anyway, they also are very big in AI, and they are very good with companies turning AI into profitable situations. So they're in the sweet spot here. But anyway, let me show you the technical analysis. I go to the 20-year graph to start out with, right? And I see that, again, the purple line, right? Once we got above gold, that was a good deal. And above purple, it's gone. It's, you got to be bullish. You got to be bullish. And so basically, it had to run up to 200. But it pulled back to here and held. So do you understand why I knew 165 was a floor possibly? Plus the RSI held 50. Now I go to the 5-year. The 5-year. It comes down again to the blue line, which is rising. When the moving average is rising, even if it gets penetrated, that doesn't bother me because it's probably a baloney trade. And then once it gets right back above blue, you know it's a baloney trade. So I knew 165, 170, again, they're all, and then these guys are meeting up. When these things meet up, something good generally happens, either up or down. So you can see once this thing turned up at 170, the blue line got penetrated above 170, there'd be no reason to do anything but buy. And look at the RSI, what it looks like. Does that look like it's going down? So obviously that was a great place to buy. Notice I didn't say buy up here. Okay, this is the normal place that I'd be looking at. Then I went to the 1-year graph. And voila, it's telling me 170 is turning up. So how many charts do I have to go to when they tell me 170, get in? So bottom line is that what you could do, I'm going to give you a few different strategies. One of them we mentioned to people, which was selling puts underneath the market. So you're at 170 or 175, you could sell puts, which means somebody's going to give you the premium and you're going to be obligated to buy 100 shares of stock at 165. Times 100 is 16,500. If you're on margin, you could put up half of that. But if you don't want it, or you don't have the money, or that's too much risk for you, then this strategy is not for you. But if you did sell the put to grab the cash, another thing you could do with the cash is you can take that money and buy a call, say up at 175 or 180. Then when it takes off, you've got the right to buy up here at 170, 180. You use the money that this guy gave you on the put down here. So that put is well on its way to going to zero. And the call that you used his money for has just gone from what? It went to 195 from 180, just went to $15. So that's another strategy, selling puts and using the premium to buy calls. But that's not for everybody. You got to have the money to buy the stock. And if the stock goes way down to 140, you have to have the ability to hold on to it if you have to hold on to it.
Jim, let me say something real quick because that brings up something interesting. Actually, we had a couple of users emailing me, and I think Doug, I don't know if Doug is in the room today, but Doug emailed me. He said, "Hey, Daniel, I can't sell puts. My broker doesn't allow me to write naked puts, uncovered puts." And this for this, you do need to have, every broker has a bit of different rules for this, but you do need to have a certain qualification to be able to execute this particular option strategy. So it's not for everyone. You need to qualify for it. You need to have the margin and the buying power to potentially put up the money if you get exercised or assigned. Yeah. But so that's not for everyone. That is why actually in your service.
Yep. I always make the comment of, consult your brokerage firm to determine your own suitability and your risk tolerance, because these are ideas we're going to talk about, and these ideas are not right for everybody. And I've got other ideas I'm going to discuss with you soon, but they're not right for everybody. So basically, that's why you talk to your brokerage firm about suitability and what's really right for you. Our job is to find ideas that might be favorable and share them. That's what we're doing.
Perfect. Okay, so we talked about put writing, about selling the put and buying the call. What other strategies do you see with IBM, for example?
There's a credit and a debit spread. So let me talk about a credit spread. Now, this is one where you have a limited risk because you have a sell and a buy. Can you see the market here was 175? Right? I'm on my screen here. So at that point, since you really felt comfortable that it was rising, somebody might have wanted to sell the put at 170. And let's just use a number of $5. And then he might buy the 165 for $3. So if you buy an option, you have the right, if you sell the option at 170, you're obligated to buy the stock at 170. If you buy the put at 165, you have the right to sell it there. If the stock stays above 170 and the time runs out, both options will expire at zero, which means you'll keep the $5 on the 170, but you owed $3 on the 165. So 5 minus 3, you would pocket $2. That's a credit put spread, or I think they call them put verticals, credit put verticals. That's basically what that is. So any questions on that, where you sell a put and buy one underneath, and then you're trying to keep the differential?
No question for me, but maybe just one follow-up. Why not do the same thing with a debit call spread? Do you have any
Well, sure.
reason? Yeah.
And then, well, obviously, then, of course, let's talk about what has to happen to win. On the debit put spread, you're short the 170, the stock is 175 or 180. If the stock goes up, you can win as long as the time runs out. And if the market goes sideways, you can win as long as it stays above 170 and the time runs out. And if it goes down from 180 to 170, but it doesn't go under 170 and the expiration hits, you could also make money on that. So there's a significant amount of possibilities that all work in your favor. Now I'm going to go over the other strategy, which is, oh, by the way, the risk on it, if it went way down to 155, well, the spread is a nickel spread, 170 and 165, and you got a credit of $2. So that means is if the spread went to the full $5, and it could if it goes down here, and it will if it goes down here at expiration, the $5 spread minus the $2 credit, remember you received $2, means that your maximum risk on this should be $3.
And
Five
just guys,
minus two creation. Yeah.
one quick clarification, and this is just something that I always say in my head. When Jim says $2, just keep in mind that per contract, this reflects actually $200 because you always have to multiply it by 100 because one option contract covers 100 shares.
Exactly. Now, so therefore, but your gain is only limited to $2. So the guys who want to try to make more money, they would buy the debit call spread. And let's say again, we're in the 180, 175 range, and you think it's going to keep going because the trend looks like it is, and they got earnings coming up. And if their earnings come up like they did, that's what's going to happen. So the bottom line is you go to the 185 call and you buy it for, say, $5, and you sell the 195 call for $2. And let's say that spread is $2, okay, as an example. So you buy for $5, you sell for $2. That means you owe $3, $300. That's the maximum risk. Because if the market tanks, you'll lose on the 185, $5, but you'll keep the $2 on the 195 you sold. So the differential will be a loss of $3. If you're correct, and say it goes spiking up to 195 like it did today, well, the differential won't go all the way till 10 because there's still time on the clock. But it certainly will be higher than the $3 you paid, and you could sell it out when it's up there. Or you can say, I'm going to sit tight because I think it's going to go back up. And if it goes to 195 at expiration, the difference between the two strikes is $10. So they're going to owe you $1,000. But you paid $3, so they're going to take that out of your $1,000, so you'll make $700. Not a bad deal. A lot better than the credit spread of 2. But here, if it goes sideways, you'd lose. If it goes down, you'd lose, and only up wins. So there's a reason why you make a lot more money on certain strategies, because obviously the probabilities just numerically are not as easy as the other. So that is a debit call vertical. You know, they use vertical. I just call them a debit call spread. Buy one call and then sell the out of the money call. At my seminars, I always used to say, and you know, when you buy the 185 call, when you sell the 195, you hope the guy you sold it to is named Albert Einstein. I go, why would you want to make him Albert Einstein? I'm selling him because if he has a chance of winning, you've got a fabulous chance to make 10 points. So that's my little joke, if you get it. You know, when you're writing the option, you wanted to sell it to some guy who's very smart, because if it's really going to 195 or better, your 185 you own is going to be gold. So that's a couple of strategies: the writing of the puts and taking the premium to buy the call. That's a more aggressive strategy because you got stock risk.
Jim,
next, yep.
We got a question coming in from G, and actually, I think this is a really good idea. What do you see currently in the market? So we discussed IBM, and do you think we can maybe discuss a setup using the options chain as well, so we can look at some concrete prices.
Sure. Okay. Again, I come out with ideas on Sunday because I do my homework on Saturday. So, but I can show you some things that you want me to give you a little hint on some of the things I'm sniffing around for next week, or do you want to go over the stuff that we already did?
No, maybe something that's coming up right now, which is relevant, perhaps right now.
Because I haven't spent all that much time on it, so I'm being thrown for a little bit of a what? But I will tell you a couple of things that I'm keeping an eye on here. Okay, first of all, I'm looking at earnings for next week, right? So I'm trying to figure out who's got earnings coming out next week. And I see that Meta's got them, Amazon, Qualcomm. Let's take a look at a couple of stocks and see where they are and see if they look any good. So the first one here, let's take a look at Qualcomm, because, that stock can move. You want to get something that's going to move, so let me get that up here. I'll just look at a few different sectors because, again, different sectors move different times. Okay, here comes Qualcomm. Where is it at? Probably already dropped. Yeah, you see, you got to do the stuff up here. You got to do it up here. You can't be doing it down here. So Qualcomm is a do not play, because right now it's hoping against hope that it'll stop. And that's not the time to do your strangle. Plus, the premiums will be huge because it just went from 230 down to 180. You understand? So that's a no sale.
And the premiums will be huge because of volatility. You can see how much that move. Yeah.
Yeah. Don't forget our game. Our game is to buy volatility before it happens, not after. We're supposed to sell after, right? Okay. So let's see if I see anything else here that might be interesting. We have got a couple of oil deals coming up. ExxonMobil. And this thing could be interesting here. I actually showed this trade to you the other day, Daniel. Remember the call spread?
Yep.
And it's obviously working quite well. And here was my idea. And now this call spread that we talked about at, I remember exactly, it was $4.50. So it was $450. And here's the deal. It was options expiring, I think, on the 9th. So let me see what they look like for the 9th. Because here's the deal. The earnings come out on the 1st, which will be next Thursday. And so I want to be covered for time-wise. I want my expiration date to cover the week it comes in and the week after. Because the week it comes in, it could get bid up in advance. And the week after, if it disappoints or even beats, it could get volatile again. So by having 2 weeks, I've got a window of week of and week after to get volatility. Now, we looked at something I thought was very interesting. In fact, I don't even see it here anymore. I have to go to all the options because the stock has moved up a little bit. So let's see what it's trading for now. We looked at the 105 calls, which now are, well, it's hard to do because the markets are closed, right? But let's just say it's 972. 972 was the last trade. And then we're selling the 110s. And right now they're showing 8. Okay. But we were showing a differential of 4.5. So that would be, that would be more like how these asks are. You have 14.20 against $8. That's about $6, right? Well, we looked at this when it was only at 4.5. So the 4.5 has already turned into 6. Now, here's what I like that. Let me go back to the chart. So you get the idea? You buy the 105 and you sell the 110. They're both in the money. You're just playing for time going by. And at 4.5 going to 10, you can double your money if it stays above 110 for 2 weeks. I like the probability on that, right? So let's go back to the chart and see if that makes any sense. Obviously, it makes some sense because 4.5 has turned into 6, but let's see if it makes any more sense. So let's go back. Let's go back. Okay. So there you got the chart. So here's why I thought when I talked to Daniel earlier, you see that it was in the 114 area when we talked, right? And I thought that it obviously came down to the gold line and held. So that's above the 105 mark. So that means if it stays above at least 108, I get $3 out of my $4 back, because 105 minus 108 is $3. And I'm paying, and on the example, I was paying 4.5. And then what's the likelihood that this thing might keep going up? Well, I thought it was pretty high at 114. So far, so good. And all now it's got to do is stay above that 110 line to double my money. And so that is an example of an in the money call where you're basically playing with time. You're saying the earnings come out next Friday, and the week after, this thing should be able to stay above 110. And as the option premiums come out of the options, which happens as you go into expiration, it'll only be worth the intrinsic value, which means what? It means if it's at 117, the 110 call would be worth $7. That's 117 minus 110. That's $7. And the 105 call would be worth the difference between 117 and 105, which is 12. So if I own the 105, they owe me $12. And if I've sold the 110, I owe them $7. Well, $12 credit and a $7 debit means I got a credit of, excuse me, this was, let me see. Yeah, this was a 10-point spread. This was a 10-point spread. And so it needed to stay above, it needs to stay above 115, 114 to make the full amount. Okay. And so, yeah, basically the idea is you need to have the market stay above the top strike price and have time run out to get the full differential. But there's a lot of other markets that I'm looking for next week because, again, next week is going to be a big week for energy. We've got this is called Phillips Petroleum. And a lot of these energy stocks are on a ledge. You see this? They're getting ready to go someplace possibly. So these are interesting to me. I wish it didn't break out already. But again, that looks like it's not going on a one-day deal. You know, it looks like it could have legs, especially if you see when all these, here, get this, when all of these moving averages come here, okay, they're not going to stay together forever. You guys have all been in a traffic jam. You got 4 cars pointing at the same thing in the middle of a rotary or something. Somebody's going to move and it's going to come out of the traffic jam. We are in a traffic jam here at what price? 138. Obviously, it's already breaking out to 142. With this kind of situation and the RSI just beginning to go through 50, there's potential to this thing of going a lot higher. And so this would have been one, had I seen this in the last few days, I would have done a strangle on this for sure. For sure. Yeah. And I would encompass next week and the week after.
Yeah, so guys, just look at the price chart in the past. Whenever these MAs met, they didn't stay together for a long time, and they expanded quite rapidly afterwards. That's actually an interesting observation, Jim. So
yes, and also it's a sector that looks like it got beat up that might be turning. This thing used to be 175. It came down to the gold line. What did I tell you about the gold line? That's the time that it's going to make a decision. If it starts trading 125, forget about oil stocks. They're dead. If it holds and it starts going up like this, maybe get on board.
Yeah.
And then if you go to a longer term graph, you can see this is in a long-term uptrend, and all it had was a pullback to the red line, and maybe the pullback is over. And then you got the 5-year, and the 5-year, if this thing blue, does that blue line look like it's pointing up or down? It looks like it's pointing up, and the red and the blue are meeting. Where are they meeting? Right at 140, 142, and that's where it's trading. So if you start hearing this thing 146 and 150, it's probably on its way to go after that number. If you hear it underneath breaking down, then obviously, and this makes it a candidate for the strangle. Because the likelihood of it moving, in my view, with energy prices, and don't forget, energy just got whacked. It went up to $85 on crude and couldn't get through. See, after I look at the stock that's in this sector, wouldn't I take a look at crude oil prices and give me an idea of what that looks like? Well, let's take a look and see what it looks like.
It recovered a bit today, yeah?
Well, you know, all I can tell you is what it is. Now, this looks like it's on crunch time too, doesn't it? It's right on the yellow line. So this thing is either going to give it up, and if it does, maybe the puts would work on that. You know, when you do a strangle, you're not prejudiced. Up or down, just don't stay the same. And the thing is like I say, this thing is very much right there. The RSI doesn't look very good, but the bottom line is the longer term is also very much in line. You see all these things in there? So I'm a believer oil is going to have a very big move. Either it's going to go into the collapse mode and shock the world, or it's going to get above this area of around 85, and you're going to see it at a triple digit. So I'm all over keeping an eye on oil because there's not many things you can say, hey, this thing's on a ledge. And let's be frank, oil is used all over the world. It's a very big commodity. So if there's a glut of it for some reason, and then the economy goes into some slowdown, well, this thing starts breaking under 70. I mean, things happen. Things happen. So it's very critical where it's trading. You can see it's held the gold, right? It held the gold, held the gold, held the gold. So if it comes down to 70 and holds, that's the bargain. That's a bargain. And I'd love to buy it at 70 if it can hold. But my feeling is not until it gets above 85 can you really get really bullish on gold, on oil. 83, 85. It's got to break above there. And then as you can see, all you got is white area up there. So I'm very interested in the energy sector. Don't be surprised, subscribers, if you see ideas in the energy sector, because the premiums seem reasonable. The charts look like they're at an impasse. Impasses do get resolved. And if you get in when the volatility is not big and they get resolved in a big way, that's where the potential lies.
Yep. And Jim, before you go to another symbol, let me grab the screen for, say, 5 minutes. We're going to come back to the charts right afterwards. So, Jim, please stop sharing if you can, so I can.
Oh, I'm sorry.
Over again.
Yep.
Perfect.
Yep, you're good.
Thank you. Excellent. All right. So, guys, now, and there's some questions coming in, Dean, we're going to get to your question in a second. And if you have any symbol requests, please also put them into the Q&A line. Now, we discussed a bunch of different strategies, and, at least for me, it's like drinking from a fire hose. There's so many different numbers out there and the terminology, and it's just complex things that are going on. Now, and we didn't even talk about managing your options trades, which is a whole different story, because once you're in a trade, you need to manage it. You need to get out of it eventually, or perhaps roll it to different levels. That's something we're going to touch upon when we come back to the charts, so real quick as well. But what I wanted to say, guys, is that this can sound overwhelming for many of us, including me. Just by listening to Jim, and I think Jim is such an expert in this topic, and he's just so fluent with all these levels, and he's just, it's just a second language to him, almost like a natural language to him. It's not for everyone. Nonetheless, you still want to, use options to your advantage and eventually to profit of options. So what can you do if this sounds overwhelming? Well, we do have, I believe, a really good solution for that. Now, hear me out. We have a special offer for you where you can get private mentoring in a one-on-one session with Jim, where you can ask him all the questions, where you can get into any topic that you're interested in and learn straight from the source, from the option professor. You can pick his brain and learn from one of the best in the industry. Now, if you want to take advantage of this, simply go to tradingindicators.com/meet, and I will put this real quick into the chat box right now. But we still have one more bonus offer for this. But let me just quickly type this into, if I can find my Zoom window back. Where did it go? There we go. Okay. So let me just type this quickly into the chat. I'm typing it in right now. So this is tradingindicators.com/meet. All right. So it's in the chat right now. Okay. Now, so you can book a one-on-one mentoring with Jim, but we are going to supplement this offering with 2 bonuses. Bonus number 1, if you book a one-on-one with Jim for a very reasonable price, you will get 1 month of his option alerts service for free. So we'll just take it off for 1 month for free for the option alert service. For those of you who have already subscribed to our option alert service, and you still want to take advantage of the mentoring, of meeting Jim and learning from the source and learning from the option professor, no problem. Take advantage of it, and we will, for the next month that is coming up, we will discount that month. You will not be charged for that. You will be refunded for that. So you can take advantage of this option as well. This bonus or this special deal will be available for only 1 week. So if you want to take advantage of it, don't wait too long. Tradingindicators.com/meet. And we will also complement it with our 6-hour masterclass on demand on options trading. We will learn everything that Jim knows in a condensed format. 6 hours. We recorded this about a month ago throughout 3 sessions where we cover everything from the basics to simple option strategies to multi-leg strategies to managing your option trade. So something to consider. Tradingindicators.com/meet. Now, if you don't need mentoring and you already know the subject very well, no problem. We also have a special deal on the option alerts that Jim puts out every single week. We actually call these the option triple play alerts, which are very actionable trade ideas, option ideas, covering 3 different areas. Area number 1 are short-term strangles or straddles, if applicable. Level number 2 is put writing, instant income generation. And level 3 are long-term directional plays, typically with outright calls or puts. And we are thinking of actually adding a 4th item to it. Debit and credit spreads, which allow you to participate in option trades in a less expensive manner because you will buy a contract and also sell one. And you only pay the difference. If you want to take advantage of this, all you need to do is to go to tradingindicators.com/alerts. And that one is also right now in the chat, tradingindicators.com/alerts. And we do also have a special offer still going on here. If you sign up, you will not only get Jim's or the option professor's option ideas every weekend straight to your inbox with very actionable ideas, but you will also get his expert market commentary every single week. And these are handpicked option ideas by Jim. He spends a lot of time researching the market. And if you don't have that time, you just want to, kind of piggyback off his ideas, this is the service you can go to, tradingindicators.com/alerts. And one more thing I talked about, a special. We have a special offer going on right now for these alerts as well. You will get the first month at a 50% discount for only $97. So this offer is going on right now for a limited time. And we complement this offer with our 6-hour option masterclass. You will also be invited to our weekly member-only trading sessions, which take place every Tuesday at 12 p.m. Eastern. These are all recorded, so should you miss it, no problem. You can simply watch the recording. You will also be invited to our Discord channel, where you can get instant answers to any questions. Our moderator, Rick, basically never sleeps, and he answers questions day and night and even on weekends. And you will get a 50% discount on a monthly subscription of our Liquidity View dashboard if you decide to do so. And all this available at www.tradingindicators.com/alerts. And this link is also in the chat. All right. So think about it. I think especially the very first deal to meet Jim, get the one-on-one mentoring and get all the education that you need is very appealing, especially that it also includes the 1 month of option alert service for free. And one thing to mention, you can cancel at any time. There are no contracts. All right. So this is the special offer we have prepared for you. And I think now we can go back to the charts again. Jim, would you mind taking over again and going through some of the charts?
Perfect. What I wanted to do, if it's okay, is to just briefly show some of the stocks that we have put out on the alert over the last month or so with earnings coming out. Obviously, I focused on that. So I'd like to show you a little ideas and see why I would have done something and how they worked out. Now, again, the past performance not indicative of future results, but it gives you an idea of what I'm looking for. And if it does move, what you can do. One last thing on mentoring. I've been mentoring people. In fact, I've got a mentoring session right after this with a gentleman named Bob out of San Diego. And some people come to me even more than, come to me month to month, because we get to talk about my charts here, but we put their stuff in there and they get another viewpoint on what they're doing. And then they ask me questions. And because it's just one-on-one, we're nice and calm. We go slow. I make sure you understand it before we move forward. And again, I've been doing the education thing for decades, so I'm pretty good at making things understandable to people. So you really should try to check that out. It is, in my view, a pretty good thing to do. Okay, so I'm going to start out here.
And please share your screen, Jim. Yeah.
Yes, I just have to put this thing up, and then I hit share. Where are we? Share. There we're share, and here we're share. Yeah, because I want to be brief on this because I'm just giving you an idea on how I come up with an idea. And these are the kind of ideas that I'm trying to put into the box each week. Okay, so I showed you what I did with Apple because they had that big event, right?
We can't see your screen yet.
Oh, I'm sorry, Jim. You know how to hit the word share? Okay.
Now it's coming up. All right, we see it.
Okay. Now, again, I showed you the idea of a big event like the conference with Apple. Now the big events are earnings. So I'm going to show you here, starting with, and I'm going to be brief, but just show you. On JB Hunt, can you see it was way down here? And then their earnings are coming up, right? So it's at 155, 160. My idea was 170 call and 150 put for about 260 bucks. When we spike up to 175, those calls go to over 7. Okay. And then when it comes back down, the put might even come alive because you don't have to sell out the put when it's up here if the put goes to 0. So that's an example of getting in before. Now we'll go to other ones where they had earnings. Remember Bank of America?
And Jim, real quick on this one, look at the moving averages on JB Hunt. They were also all intermingled at the same spot. Pretty awesome.
Exactly. And again, I try to give people a visual. Imagine you got 4 guys in a traffic jam. Are you going to stay there forever? You're going to miss dinner? Somebody's going to make a move, right?
Yeah.
So that's the idea there, to put it in layman's terms. Okay, in the Bank of America. Okay, before the earnings came out, Bank of America was trading at between 38 and 40 before the earnings. Our idea was 41.50 call and 39 put, $1 and change. It goes up to 44 and change. The calls alone have tripled. So the bottom line is that's where you buy before earnings come out and you get a hit. Next one up that I wanted to show you was on Halliburton. Halliburton was trading before their earnings came out between 34 and 32. Again, I'm noticing they're winding up down here, right? It's double bottom. All the averages are meeting again. I say something's going to happen with earnings. So I do 34 call, 32 put for like $1 and change. Goes up to 37. Again, another 3 or 4 times what you put into it. And then again, if you don't sell the put, it comes back down. Or if you're taking a profit up here and you can see it's still in a kind of a down deal, you could take that 32 put and move it up to 35. And then when it comes back to 33, those can make you some money. So that's the way, that's called pressing your put, where you have a put down here and a call, you're taking a big gain up here and you have extra money. So you say, you know what, I don't think it's going to last. I'm going to move my put from 32 up to 35. And if this thing comes back down, these 35 puts are going to explode, which is exactly what happened. Or it could have kept going and you'd lose on the 35 put. But in that case, it would have been a brilliant idea. Another one that we had here. Let me see here. Well, we had Taiwan Semi, so let me show you that. And this was for last week and this week. So this expires tomorrow. Obviously we're gone out of it. As far as everybody should be gone out of it because obviously it's running out of time. But here, let me show you how I figured this one out. You see, this has got a big uptrend, right? And you see how it's trading. And again, don't forget, my prejudice was that there's a reversion to the mean going to be happening. So if there's a reversion to the mean, that means all this stuff that's way up here is going to come back towards the moving averages. That's what reversion means. So I also looked at this. You see the high price right here? It's at 192, and the RSI at the bottom is at 71. 192 and 71. Look at the next high. It's 193, and the RSI is only 62. That tells me you're running out of gas. So the likelihood that this thing could pull back is pretty good because it ran out of gas. So I took the 180 put on this idea, and the 215 call came in for about $500. Today we went as low as what? 152. That means at one point the 180 put was worth almost $30. That's $3,000. And your maximum risk on the idea was $500. That doesn't happen all the time, but there was a couple of times it just happened with what? With Apple and with this. And, we don't know, but again, that's why you diversify. And that's why sometimes it can happen like that. So, these are the ways that I'm trying to come up with things that will be very volatile. Here's another one that just happened really today. This is Alcoa aluminum. I didn't think this was going to work. For a while, it was staying between the two windows. This we had a call at 42. And again, why did I do 42? Can you see all the averages were right here? So I did a call at 42 because I actually thought it might keep going up, but I throw the put in at 36. And we paid $139 on this idea. $139. The call and the put, $139. And today I see it went all the way down here. And at one point, the puts alone were worth $4. So $139 was the risk and $4 was the potential here. But again, it didn't happen right away. And had it not moved, you'd lose on both sides. But in this case, it worked out because the volatility continues to be, very good in this market because, people are seeing that, the winds have changed. There's a rotation right now, or has been, out of the tech and into the small caps. And I've told people about that a month ago. The reason that's happening is as simple as this. The small cap index on the S&P 500 is called the S&P 600, and it has a PE ratio. That's a valuation measure, price to earnings ratio. And then the S&P 500 has a PE ratio, and those are large caps. The difference between the two, the valuations, hit the widest level since 2000. And the last time it hit that wide of a differential, meaning the small caps are dirt cheap compared to the big caps. The last time that happened was 2000. And in the 3 to 5 years following, small caps outperformed the big caps every year. And I'll show you just today. QQQ would be the what? The NASDAQ. And it was what? It was down 1.1%. Okay. IWM is the small caps. And that was up. Now there's a good example of what I'm talking about, right? They're outperforming already because, again, their valuation is very compelling. And some people obviously are saying that if we have a lower interest rate environment, it'd be very helpful to the small caps. And if you look at the small caps, they are miles away from their highs comparatively. There's your high on small caps. We haven't even made a new high. You see 240 is the all-time high. We're still down here. Do you know how far above the all-time highs we are in S&P? Way. So again, that's what I do. When I speak to people, it's like this. Every week I'm going to do the homework to try to find, and I love the strangles now because the premiums are your maximum risk. And if we can catch volatility, you can make some money. So, if we can find some good stuff that's going to move, this is a way to risk a little and maybe take out a lot. And again, you get that, course, 3 sessions, 6 hours. You need to know more about options. That's how you're going to do it. And then you can do the mentoring session if you like, or just get the sign up for the letter, for the report, get your course, and then get started and start getting
Yeah.
ideas and information flow.
And Jim, we have some
Yeah.
questions coming in just real quick, so we can cover these. Somebody wants to know, how are these alerts being sent out? So these are sent out by email, just conveniently to your inbox every weekend. Typically Sunday morning you have them, so you can go through them and then prepare your trades when the market opens on Monday. So that was one question we got. How many alerts per month? So they come out every week, so 4 to 5, depending how many weekends are in that month, because they go out every weekend. Dean wants to know, what's the gold line on your chart? This is the 250 simple moving average, Dean. And Jeff wants to know, what's your take on Amazon with earnings coming up? Do you have anything to say
Well,
about
let's
this?
take a look at Amazon, and I'll tell you exactly. This is what happens in the mentoring session. If people have stocks they own or they want to do, or they have a question, they go, Jim, I have this or I have that. What do you think? So here's what I do. Amazon. First thing I do every time is go to the long-term graph. I want to know where we are. And obviously I know we're on the all-time high. And again, we're way away from the averages. So what are you doing? The same thing I told people in the newsletter, by the way, that you get every week. I give you a review of all these markets. So you would have known that I've been talking about reversion to the mean for the last 2 weeks. And if you understand that, you wouldn't be buying a bunch of stocks at the all-time high if the guy who you're reading says it's going to revert to the mean at some point soon. Okay, so the bottom line is now, what do you think? I think it's come in here and it's broke these two, and you're at risk to go down to blue. What's blue? 173. What does it look like on the 1 year? So 173 would be a line in the sand. I would risk between here and 173 if I was bullish. Now it's penetrated the purple here, but here's the key. If it gets back above purple, then this was a baloney trade. So right now, you got to keep it above purple, which is at 181. So what did I tell you? You got a 173, and you need to get it back above 181 to get back on the horse. So those would be my key numbers I'd be working with. It's at 180 in the aftermarket. You start trading above 181, 182, call me. You might have something going. If you can't get above that level, and again, we also know there's support at 173 because we have got our other chart with the blue line rising. So we know the trend is up, and we know that can be support. You see this thing here where it stopped? Wouldn't that have been a nice place to buy on the pullback? Sure would be. So that's why that number is important to me. So again, you have your numbers, 173, and you get it above 181. Now on the monthly, what's it telling me? The monthly, the low here was 28 on the RSI. The low down here is 40. That's a divergence, and that's a positive. Okay, so would I be pounding Amazon here? No. Would I be looking for it to possibly turn? Yes. What would make me think it's going to turn? Getting above that 181, 182 number would be a start. And then when would I think this thing might be really having trouble? If it breaks under 173. So basically, that's the way I would see Amazon right now. On the 5-day chart, again, we'd like to get it above 182. Do you notice these lines are meeting right where I want it to get above? So if it starts breaking above 182, then this red line is going to start turning up, and the 5-day graph will start getting better. Again, it's obviously in a negative mode here because it just dropped from $200 or whatever to 180. So you can't expect the charts to be pointing up on the short term. But the longer term is telling you that it may be close to some support level. And this is the kind of company, because they have the cloud service, that could really blow you away on earnings. And so basically, you got to be careful, with this thing, because, but again, on a longer term basis, there's no question this thing is extended still. So you do have a risk on the downside. If you break 173, 160 would be the next number. I don't pick numbers out of my ear. I use the moving averages because I always tell people moving averages don't lie. People lie. And so I like to trust the moving averages because they're based on price and time. And unfortunately, price and time is not debatable.
Would you strangle Amazon if prices were reasonable for a tight
If they were
strangle?
reasonable, I would. And in fact, let me tell you where I might have done it. On the 1-year graph here. Yeah, get this. Okay, where's my RSI? I'm up here where? I'm at 70. Now we're making new highs, and the RSI is in the 60s. It's out of gas. So what? You buy the 210 call and you buy the 190 put, and you're $10 in the money, and maybe 2 or 3 or $4 has turned into at least 10.
Yeah.
So yeah, I would do it. I would do it at the right time. Here is what do you call it? It is shall we say, already made the move on the put. So that's going to make the put very expensive. And then people are always bullish on the calls. So I'm sure the calls a lot. So again, up here, when it's gone sideways and quiet, you probably could have got in there for maybe $5, like I did with Taiwan Semiconductor idea. And then you get a nice move and you make money. But once these things move, they're on the do not play list, in my view, because I'm only looking to risk a little to make a lot. If I'm putting up a lot to make a little, then I'm in the wrong game.
Great. I think that makes a lot of sense. Yeah. And finding these stocks which are quiet right now, which are at these pivotal areas, that's the option professor's
That's my job.
Yeah, exactly.
That's my job. Yeah. And like I say, on a month-to-month basis here, you're not signing up for the Marines. You know, you can try it for a while. I think you'll be very happy with it, but we wouldn't want you to stay into anything you're not happy with. So that's why we have the month-to-month relationship. And again, you get the master class right up front. So it's kind of silly not to get this. I always tell people, you know, $97, put it in perspective. 2 guys go out to dinner. They're above 100. So miss a meal 1 month, you lose a little weight, and you get this stuff. That's what I say.
Perfect. Yeah. Thanks, John. Jim, this is a great closing word. And let me grab the screen quickly back again.
Okay, so sure.
A quick reminder. Yeah, if you want to take advantage of our great mentoring offer, which will get you 1 month for free of our option alerts service, along with the 6-hour masterclass on how to master option trading, recorded by Jim and ourselves, simply go to tradingindicators.com/meet to book Jim's expertise. I think you cannot find a better deal than this if you really want to kickstart your options trading. And if you're well versed with options already, no problem. You can still take advantage of our great alerts offer, which comes out every single week, every weekend, by email straight to your inbox. We will cover short-term strangles. As you could tell today, one of Jim's and the option professor's favorite option plays, but they need to be well-timed and need to find the right moment to do these strangles for the right symbols. And that's his job, to pinpoint these symbols which currently are in these faces. But we're also going to get income-generating put writing ideas, along with some long-term directional plays which are looking for the next home run, which typically have expiration dates further away, like 6 months away, for example. And we're thinking, as an additional item, to add debit and credit spreads to the mix as well, allowing you to get into the options game a bit cheaper, because you're selling a contract and buying one, and you only pay the offset, the difference between the two. All right, perfect. So here the URL is tradingindicators.com/alerts for this service. And a quick reminder that you will also get Jim's market commentary along with the option ideas and his outlook on what he thinks might be moving. And this may or will include areas which are not necessarily option related. For example, his outlook on the S&Ps, where these might be moving to, or the commodities, the interest rates, and so forth. So tradingindicators.com/alerts for that.
And one thing, Daniel, I wanted to add is a few weeks ago, I identified Grayscale Bitcoin, GBTC, on a very key level on my chart at $48. And with guys like Tom Lee saying Bitcoin could double in the second half of the year, I thought that was an outstanding time to take a chance on GBTC at 48, because it was right on one of my lines. And within a couple of maybe a week, it was at 60. So some of the ideas that are not actually on options that I bring to your attention because I see them as potential favorable deals, I also put that in there as well. So you're getting obviously a lot of good stuff, in my view, for a very reasonable amount.
Yeah. And one question came in, Jim, is somebody wanted to know, what is the difference between the 1 hour deal and the 3 hour deal for the one-on-one mentoring? So here's the site that you see when you open up the link that I sent you in the chat. And you can see that you have these two options. So by default, you can select the 1 hour one-on-one mentoring for 197 or the 3 hour, which will get you the mentoring a bit cheaper for a discounted price for 497. But the bonus offers will be the same for both options here. So you make the pick. Either you pick the 3 hours or the 1 hour. The bonus offers the 1 month free of option alert service will be included, as well as the option masterclass. And one thing I wanted to mention, if you have already the option subscription, no problem. We will just credit you for your next month. So this is no problem if you take advantage of the one-on-one mentoring. All right. So I hope this clarifies this. Okay, guys. So I don't see any other questions coming in. I know the option professor has actually a mentoring coming up right now. So I don't want him to be late for this. And guys, if you have any questions which were not answered, no problem. Please simply drop us a note. Go to our homepage, tradingindicators.com. In the top right corner, in the main menu, you see a contact item there. Click on it. This will open up a contact form. Put your question there, and it will go straight to inbox. I will make sure to answer every single question personally. And if needed, I will forward the question to the option professor as well. All right. So, guys, with that, I hope you enjoyed the session. Yes, and I look forward to greeting you on board, perhaps for our option alert service or for Jim's one-on-one or the option professor one-on-one mentoring, or perhaps at a later webinar. Until then, guys, thank you so much for listening. Have a great evening and talk to you soon. Thank you, Jim, for your presence as well.
Thank you, Daniel.